Alright, so welcome to this training. Today we're going to be building up on what we talked about yesterday. Yesterday we talked about single candle order blocks, right? So talk about single candle order blocks yesterday. So now we're going to talk about one important concept that makes single candle order blocks very high probability, right? So this is going to be a continuation of the single candle order blocks, but this one is going to make you have a better understanding and appreciation for what you are doing. So now I want to talk about a concept that many people do not talk about. I want to call it engineered liquidity, right? Engineered liquidity. All right. So engineered liquidity. All right. So or you can call it inducements, right? So whatever you want to call it, you can call it inducements, or you can call it engineered liquidity, right? So you can call it either engineered liquidity or inducements, right? Some people call it IDM, all right? So now we understood the concept of single candle order blocks yesterday, right? Now, single candle order blocks, I told you guys that I told you guys how it's formed, I told you guys where it occurs, and all this fun stuff. All right. Now there's something that makes it very, very unique, right? Some people call it the ABC model, right? Some people call it the ABC model, ABC pattern, or ABC model, right? ABC, right? So some people call it ABC. So now, when the market creates a single candle order block, right? We like to see price, leave that order block unmitigated, right? And then create what? This inducement. Now, the purpose of this is to act as what? An engineered liquidity or inducement, right? Now, some people that trade patterns would see this as what? A double bottom. So they will try to take their trade from that point, right? So they will see that as a double pattern, right? And then price does this and then runs above. Now, what has happened there is that some people will buy it thinking that this is maybe a demand zone, right? Some people would have been buying at this point here, thinking it's a demand zone, right? Thinking that it's going to hold, right? Or they'll be seeing this as what? A support, right? A broken resistance turn support or whatever the case may be, right? Let's assume that maybe this high was there. Assume that this high was somewhere around there, right? Some people would have been, okay, this is a key level, right? They'll be like, okay, market hit here and rejected. Market also came here and rejected. So they'll be like, okay, this is a key level, right? And then they will put in their buy entries there. And then what the price do? Price will go lower to hit what? Your original single candle order block before they what? Reversing what? In the opposite direction. Now, the purpose of this is to induce traders to take a buy at this point here. So this is what we could refer to as what? Engineered liquidity. Engineered liquidity refers to what? A high or a low that forms before your original point of interest or before your original order block. Right? If you have an order block, sometimes highs or lows form before it. Right? That high or low is also referred to as what? An inducement or an engineered liquidity. Right? So I don't talk about ABC model now. Let us focus on the logic behind it, because what makes you money is logic, the logic behind your trade. It's not necessarily the name, whether it's BBC pattern, GGB pattern. It doesn't matter what it is, or channel TV pattern. It doesn't really matter. What matters is what you understand why price is doing what it's doing. Right now, I am not saying that there are cases where price wants to reject from this. Right, at times in which price will tap here and then continue. It happens. What I'm saying is that in the case of spotting your high probable trades. Now, let me explain something now. There are two kinds of trades. We have what? We have high probability trades, right? We have high probability trades, and they have what? Low probability trades. Now, the fact that a trade is low probability doesn't mean that it cannot play out, right? Low probability simply means that the chances of this thing playing out is low but it can still play out, right? If we say, okay, if we say that, okay, let's assume that we put um okay, we throw, let's say we carry a a a bag, and inside that bag there are five different colors, or let's say there are 10 different colors of balloons, right? Or let's say of tennis balls. Maybe you color your tennis ball like red, blue, green, orange, cyan, all those colors, right? And now they ask you, you should put your hand there and get a red. Now, seeing that there are 10 different colors and you're asked to get a red inside a bag of 10 different colors, 10 different balls, right? 10 different tennis balls, right? Then they're asking you to get what? A red out of the 10 different colors. Now the probability is what? Low, but it's still possible they can get 10. But if they tell you that inside that bag of 10 balls, there are five red and then other colors. Now, knowing that there are five red and then other colors five, they ask you to pick a red. That means that the probability of getting a red has what increased because there are more red there. So what I'm saying is that probability simply means that there's a higher chance of something playing out. It doesn't mean that it will not play out at all. There's a chance of it playing out, but it doesn't mean that it is zero. Low probability simply means that yes, it can happen, but it's not going to happen often. So low probability simply means that it can happen, the setup can play out, but it's not going to happen often. That's what low probability means. But high probability means that the chance of this thing playing out is higher. Now, so because some people ask me, so what of times that the market did this? It's hit here and then play out. That is a low probability condition, right? The goal of your trading is what to be looking for high probability conditions. That means if something occurs 10 times, you want to be at least winning it at least 5 times, not when it occurs 10 times and only 2 times it plays out. No, you want to be winning more times than you lose. That's what makes it. You want to be winning more, right? You want to increase your win rates. You want to be taking losses left, right, and center, right? So, knows that. So the high probability condition is when the market comes for the inducement and then goes higher, and the price goes for the inducement. And this is a high probability scenario, right? This is a high probability scenario when the market does this. So this is what we call an engineered liquidity model, right? So engineered liquidity comes in different ways. Sometimes it may look like this, right? You can see price zones like this. We have your POI, right? So we have your POI. Sometimes price can do something like this. Sometimes price can also, it can also look like this, right? So price can also engineer liquidity just just above your POI. So the price can do something like this. Engineer liquidity, create some kind of push up. So some people are thinking that price is going to buy, will not be trying to buy at this point here. And then price in other words come to the original single candle order block and then what push higher. Right. This is also a form of engineer liquidity, right? But in my opinion, the one that is more probable, right, is this one. Yes. This one is, this particular one is more probable than this. Because sometimes this can be a continuation for bearishness, right? It can be a continuation for bearishness, right? So it also happens. So price can do something like this. Like it wouldn't make a new high first. It just something like this. To just push and then tap in. So this one also happens too, right? It also happens. Where price will create a kind of original liquidity before your original PY and then what push higher. So it's also a condition that occurs in the marketplace as well. So that's also a possibility. All right. So you have to be very, very mindful of all these things, right? Very, very mindful of them. Right. Well, these things can be the difference or it can make a difference in your trading, right? So that's what the refer as was engineer was liquidity. Right. So engineer liquidity. Now look at a very good example here. Look at it there. So now look at this other block resting here, right? So you have this particular other block here, right? So you can see how price created some kind of can you see this how price created some kind of inducement here? Right? Can you see how price did this inducement? It kind of came here and pushed lower immediately. Then finally came back and then pushed, broke below this low, right? So I think this was a better trade, right? All this was just a manipulation, but this was the main trade here. You can see this inducement here. You can see how price came, tapped and what went for the low of that candle, right? and then consequently it went for what? This low here, this lower low. All right. So this is a very good case of what? Engineer liquidity. So we had this other block that price we wanted to tap into. You can see our price came very close. Like this was like 3 pips. It came 3 pips to this point. Now fell down. So someone that is seeing this, the best might be okay. This might be another block. Right? Someone might be like, okay, this is another block. Let me take myself from this other block. Right? So if you are taking yourself from this other block, some people like the issue now these days is that a lot of smart money traders like trades where they can use small or tight stop loss. Right? They want to be having 1:10. And let us examine this trade now. So someone would have seen this trade and was like, okay, let me short this. Right, so they put the limits here, so it will be something like so you see if you can see that from this maybe your solar maybe a bit above. This was like 1:4. This is like 1:4.3. So someone would have been targeting to make 1:4.3. Meanwhile, the original POI was above it, right? Just above it, right? So someone would have targeted 1:4 here, and you can see our price did him that did give led him, came to the original POI, and then was dropped towards make a new low. So you can see that is one of the reasons why you must always consider the POI, right? Oh, it's always best that you take the POI that is close to what that has an inducement close to it because that makes it a liquidity run. As price run this liquidity, you can say it dropped and then will drop forward this low here. So that's what we call an inducement model, right? This was a very, very good trade opportunity, right? Look at another one here. Look at this other block as well. Look at this. Right? You can see another example here. This is what we call it. This is what we call engineer liquidity, right? So this is a very good example as well. You can see this, right? So you can see how price did something. Look at can you see how price came very close to it? It did not have. Let's zoom in so you can see this very clearly. I want you guys to understand what I'm talking about. Look at this other block here. Right, this last up candle here. This is the last other block. Right now, can you see how price came very close to it? Can you see it came like it's like just says this is like 1 pip or 1.4 pips, right? It just came very close and was dropped off. Now this is what we call an inducement, right? You can see how price did this, made us inducement, just came very close and then further. Finally, market came back to the original order block, and what you can see was this drop off, right? So this is what we mean by engineer liquidity. This is what we mean by engineer liquidity. All right. So now let us briefly talk about the idea of mitigation. So I told you guys that yesterday that the best order blocks are the ones that have imbalance, and you can see some kind of velocity. It came with kind of movement to the opposite direction, right? I told you guys that the best trade opportunities are the ones that where you can see some kind of inducements, right? Some kind of inducement, right? Before it, and then I told you guys that to know your mitigated order block, you want to see the market create some kind of big, you want to see you want to see big candles after it is printed. That means this candle has some orders. You can see as this candle printed, you can see this big, 1, 2, 3 red candles, and the market went down with velocity was below this low here, right? Below this particular low here, right? So that what makes it an order block. But I want to see this kind of displacive movement, and then what? Once the market create imbalance, and then sponsored by what an engineered liquidity. All right. So this is how this is pan out, right? So it's very, very logical to expect that this market is going to make a new low since we have taken out the inducement. So if the market wants to continue being bearish, then of course it has to come and make a new low. So expecting price to go to this low will not be a bad idea, right? So price to go to this low will be a bad idea at all, right? So this will likely be where price should go for this overall swing low, right? Since we are taking out this and we hit our original PY, right? So that's how this is occur. Now remember I told you guys that you should always use the extreme order block. You can see that at this whole point here, there's no other block that has an inducement apart from this one. So always use the extreme order block that has an inducement. Start from the top. Whenever you have a trading range, right? So whenever you have a trading range, you pick your order block, start from the top. Look at the one that has some imbalance. So you start from here, you check if it is tapped into, you go for another one. You keep checking so you get the other block that has an imbalance, and then obviously a plus is when it has what an inducement just above it, right, or below it rather. So you can look at this point here. There's no other block that has You can see all these candles have been mitigated. What do I mean? Watch this. Look at this. So you can see this round block. Can you see how price, push down and then tap into it? So that's another block has been tapped into. You got another other block here. This one here. What happened again? You can see how price still came back and tapped into it. So markets came back. Can you see an inducement that was created there? Markets came back. Means that inducements here. This is an inducement high. And you can see this inducement high here. The market still came back, tapped into it, was dropped off. So you can see how price has just been making other blocks and been tapping back into it. But now, if you look at this whole price action, it was only this candle that was left untapped. That means price did not tap it or mitigate it. That was the only candle that was left, without being mitigated, right? So that was what made that one particular one was the candle of interest, right? The candle of interest, right? The candle of interest. So that is how we classify our engineered liquidity. Please, if you have not subscribed to the channel, please do want to subscribe to the channel so that we can, I checked analytics and I realized that most of you guys that are watching these videos are not subscribed. So please do want to subscribe. It helps me move the channel forward. When you subscribe, it means that you support the channel. When you subscribe, it means that you love what we're doing here and you want us to do more. And when you subscribe, it helps us to, to reach more people because the algorithm would know that we are actually dispensing value. So if you just watch the video and you don't subscribe, you're not doing the channel any good. So just take a few seconds, just maybe 2 or 3 seconds to click on the subscribe button and also turn on the notification bell because this trading is continuing for the next 21 days, right? This is the 9th day, and I think we still have about 21 days left, right? So let's wrap it up for today. So this is basically what I have for you. I think that maybe I should check if I can see a bullish example. Let me just quickly go to USDHF because I think that USDHF has been bullish for a while, right? So let's look at USDHF. I think that this has been bullish. All right, let's use Pepperstone. All right, so this is an example of a bullish one. So, all right, so let's just quickly look at this. All right, let's go back a bit. All right, so let's go back. Let's see if we can see something that's interesting here. Although I don't usually like USDHF price action because of it doesn't really give that smooth price action. But let's see if we can see something on it. All right, this market has just been doing its own thing. All right, it has just been doing its own thing. Or should we check another market? I can't really see. Okay, can't really see inducements here. Because USDHF is always very, very crazy. Let's check another pair. Let's check the Nasdaq. I don't know if it's okay. I think that's been bullish too. Okay, yeah, it has been bullish. So this is it. All right. So you can see how these things play out. So they always play out. Right? They always play out. I'm trying to get bullish examples. Right, I've seen one here. So you can see this example here. We have what? This is the last okay. I can use this whole move because this candle does not have an imbalance really. So okay, let us use it. So you can see this one here. You can see this example here. So so you can see how our investment was created around there. So you can see this investment markets came pushed into the other block and what rally to the upside. All right, so and then that's been on that since then, right? You can see this example as well. Look at this. It was the last push down, right? It was the last push down, and they can see what this. See how price came, tap into this, and then let's check the 30 minutes because I think that thing is clear in 30 minutes. All right, that is clear in 30 minutes, right? All right, yeah, it's clear in 30 minutes. So you can see it's very clear in 30 minutes now. All right, so you can see it. How target took out the investment and then what came from other block, right? These were also other blocks. So sometimes it's always good to swap your time frame because sometimes on a particular time frame it doesn't look clear. So it's always best to whenever you're taking your trade, always compare the time frames. Don't just stick on one time frame. I am against one time frame, one pair, one setup. Sometimes you can see how that move was not clear on the 15 minutes. Or maybe I came with the 30 minutes, you can see how it's very, very clear, right? Very clear. Can you see how it's very clear on the 30 minutes, but on the 15 minutes and 5 minutes is not clear. So always do what to change your time frame so you can have a better feel for what price is doing, right? So look at this example as well. Look at this one. So can you see this order block here? Can you see the same thing happens there? An inducement just here. I see how this is are playing out nicely, very perfectly, like one move, one run, right? One touch, one move, right? So you can see this is a call on repeat. It occurs on repeat. It occurs every goddamn day, right? Every goddamn day, right? So it's just your duty to anticipate them, right? Because I've told you, and of course, you don't have to trade every day. And why I told you guys, you don't have to trade every day, right? You don't have to trade every day. If you can't see a very clear move, just stay out, right? Because when you stay out, you still have equity for tomorrow, right? When you stay at the market, you have equity for the next day, right? But if you are trying to catch every single move, you're going to end up blowing your account before the good moves come. So good moves do not come every day, right? Just note that good moves do not come every day. You can see how the market has been treating us. Can you see that there's not been any clear good move here? Unless maybe we're taking, buys below the swing low, right? Of course, in business, it's not the only way to trade. But you can always take your buys when price take out liquidity and then give you what a reversal below it, right? So I'll teach you guys that as we continue. I'll teach you guys reversal entries, right? As we continue, reversal entries, right? I think that will even be tomorrow's class, reversal entries, right? So now I'll visualize tomorrow how to catch a reversal like this. Cassava price took out this low. There's way to catch this kind of buys. Right. It's very, very nice if you can do that. All right. So that is it. So I would like you guys to subscribe to the channel if you haven't. Like the video. Look at this other block here. Last down candle. You can see how market did that nicely. Right. This is another block. Right. I told you guys that you must always pick the candle that has the inducement. That has what the that has the imbalance. Right. So you're not taking this whole move because you want to take from where the imbalance started. So the imbalance be gone, right? This is the last push. You mark the next candle because now the reason why I mark this next candle is because we choose the right candle now. The red candle was already tapped into. Why? Because you can see how price closed above the red candle. Look at this. You can see how price closed above this red candle and then tapped back into it. You can see this push. Look at it. Just look at this. Markets went above the candle, then came back to tap into it before it was moving higher. So that means this candle is mitigated. So you have to do what pick the candle that has the imbalance. So this is the candle of the imbalance, this one here. So that makes it what your PUI. All right, this is your PUI. So when I guys my inducements, can't you see it? Yeah. Well, this took some time. It took a lot of time to come back, but it still did, right? You can see how this panned out and what happened. The buy continued, right? The buy continued. Can you see it? So it's a very, very good, nice move. Inducement, tap into the other block, and then was running higher, right? Very, very clean move. Very, very clean move, right? So that is basically how to pick your areas of interest, right? Start to pick your other blocks and all of these fun stuffs, right? So I think that we can wrap up for today. We can wrap up our classes for today. Look at this one. So look at this other block here. This one was not tapping into. Look at this. So it wasn't tapping into. The other block was still intact. Price didn't tap into it, right? It didn't really tap into it. So market still came back here. Took out this last inducement here. Right, this is the last inducement. Can you see it? The price came tapping into it and then was pushed higher. Right. So that is it. So today is the ninth day of this training. Right. So I want to continue tomorrow. If you like this video, do want to subscribe to the channel, share with your friends. I will see you guys in the next video. Talk to you when I talk to you next time. Have a wonderful day. Cheers and God bless.